So today we're going to walk through a deal that I just sold this summer, $2.6 million deal. I've gotten a lot of questions about it, so I decided to kind of go through it overall in this webinar. So basically, the deal itself, and I'm sure those of you who followed me for a while know about it, 48 units, all one-bed units, pretty small, around 400 square feet, and sold this for a 5x multiple in just under 2 years. It was 22 months or so. So let's get into it. All right, so before we get into it, I'm just going to talk about the agenda. So going to start off just talking about going through the case study itself. This will take a bit. I anticipate 30 minutes. I'll try and be as thorough as possible. I'm sure I'll miss some things. If I do miss anything or if you have any questions, feel free to just drop that in the chat and we can go through that in the Q&A at the end. I'm going to hold all questions till the end just to make it easier. And then I'll be going through the acquisitions bootcamp, the product I'm very excited about. After that, and then the Q&A. All right, so here's an overview of the deal itself. So you'll see here that it was started out as 44 units and became 48 units. That's not a typo. It's actually intentional. So basically, it started out as a fractured condo deal, which means that we bought 44 of the 48 total units of the overall condo association. So we bought a majority of the units. This is very important. We need to buy over 80% to have kind of full control over the condo association, which became important later on for a lot of different reasons, which we'll get into. But that's the reason here why we started out with 44 units and went to 48. So bought those for 2.6 mil in September 2021, 800K of equity in that deal, and sold it for 6.4 mil in July 2023, $4.1 million of proceeds, 5.2x multiple, and 145% IRR. Obviously, pretty big numbers here. This was a great deal. I would say most firms shoot for like 15% on the IRR. So we were able to really, really outperform that. Cool. So before we get into the deal itself, I just want to kind of walk over the backstory because I think it's important to understand the context of the deal itself and kind of what it takes to get to the point where you're doing deals like this. So I started my career in institutional real estate private equity. So worked on deals in the $20 to $200 million range across asset classes, but really with a focus on hospitality and office. Most of the hospitality is kind of Eastern Seaboard. Most of the office was in San Francisco. So that went really, really well. I would say I focused mainly on the office side by the end of that. And pre-COVID, the office side in San Francisco was a pretty incredible place to be. I mean, basically they restrict office development with all these props, Prop M, Prop D, which get pretty technical, but basically what it did is made it so that you can only put, let's call it 2 to 3% new supply in every single year of the existing supply. And the tech sector was exploding. So it was a great spot to be, did really well. Obviously, a lot of that changed during COVID, which is around the time I ended up leaving, but I was about to leave at that point anyway. And this is one of these things where you kind of have to look at where you're going to end up. And I think a lot of people don't do that during their career. But basically, the firm I was at was deploying, let's call it $100 million of equity a year, which is roughly the deployment number. And the way it worked is you kind of average out that most deals, on average, your deals are going to 2x or so over 5 years, right? So you say that 100 mil turns into 200 mil over 5 years. 100 mil of that is profit. 100 mil, that's principal that goes back. And of the profit, given the promote structure, you take around 20% of that. So the firm was making kind of 20 mil profit, let's say on a yearly recurring basis once you really get running. And I knew based on the way the firm was set up, it was kind of top heavy and all that, that I was only ever going to get 5% of that promote, which is fine, right? You're basically making $1 million a year in addition to your base and bonus. Let's call it you're like $1.5 million or so. But to me, that wasn't enough. So I always planned on leaving just because I knew it was never going to be the point where I wanted to be. So that's kind of the first thing is if you kind of run the math, it almost always makes sense to leave. And I think a lot of people just don't do that or they don't want to do it. But it's pretty simple math. And unless you're really at one of the top end shops where you have a ton of carry, you're pretty much going to need to leave to make the real money you want to make. So that's kind of the first thing. You almost have to kind of, if in real estate, you really want to be on the entrepreneurial side and you want to do the deals yourself. The next thing is I started buying the deals almost immediately. And I think this is something a lot of people miss is they wait a lot of time to buy their first deals. I think that's a huge mistake. Basically, every single thing you do compounds in real estate. So your relationships compound on the brokerage side, on the equity side with your investors, on the debt side with lenders. All of that compounds, right? Your market knowledge compounds every deal you do. So when you kind of say, hey, I'm waiting on X, or I'm going to buy a deal in a year, or anything like that, you pretty much end up wasting a year or two of compounding. And it really adds up over time. So I would say, like, you almost always want to be doing, and this is what I did in the beginning too. My first deal wasn't a total home run. It was a small triplex, right? But it just got me in the game, and you just need to hit base hits in the beginning. You hit a few base hits, then you hit home runs. So, I mean, that's how I look at it. And I think that's a huge mistake a lot of people make, is they wait a long time because they want to do a deal that's big, or they need scale, or they're afraid to start. And all those things, it just kills you, right? Because it just takes so much time to get going. And the longer you wait, the more compounding you miss out on. So my first deal here was basically really small. It was a 200K triplex. I had almost no money at the time. So I put in $2,500 of my own money. That was really it. The rest of it I raised. The deal actually had no debt. And then sold that a little over a year later for $270K. So just a fine first deal, right? Nothing crazy. But what it did do is it set me up for the other deals, right? And I started doing bigger deals after that, and bigger. And I think that's another thing people really miss in this equation, is they always assume it kind of scales linearly when it doesn't, right? So you can do your first deal as a triplex. Your next deal could be 15 units. Your next deal could be 50 units, right? It can all scale very, very easily. And just to give you an idea of the deals I'm looking at now I'm looking at $10 to $20 million deals regularly, right? I'm looking at a few 20 plus. So it all scales, right? You don't need to be doing this linearly. You don't need to be say, hey, I'm buying a triplex, now I need to buy another triplex. And I think that's another spot people really get tripped up on, is because they view everything on a linear scale when it really becomes exponential. I mean, when you're managing real estate, the difference between managing 20 units and 80 units is nothing, right? It's the same thing. All that's changing is the number. So you really have to kind of look at it that way too, that you could be buying a 5-unit deal today and you could be buying a 20-unit deal next year, right? It's a very simple process in real estate because it's so repeatable and the deals are so similar, which I think is very different from other asset classes, where it does get very different once you get bigger. The other thing I want to note here too is I was able to leave my job relatively early. And I think a lot of people aren't able to do this because they do it completely wrong. A lot of it has to do with starting to buy deals earlier too, right? Like I said, it all compounds, right? So if you said, hey, I want to leave my job tomorrow, right? And you've never bought a deal, I tell you it's a horrible idea, right? Because you basically need to catch up on all the compounding you didn't do by not buying deals earlier on. Meanwhile, if you've done a few deals beforehand, right, you have the equity relationship set up, you have the lender relationship set up, you have the broker relationship set up, you have the market knowledge, then you're fine, right? Then it's easy to do. And I think that's where a lot of people get tripped up too, is they say, oh, it's really hard to leave your job. It's like, well, yeah, if you go cold turkey, it is really hard to leave your job. But if you're smart about it and you kind of set it up, and I'd say you probably need some time. I mean, maybe it's a 3 to 5 year timeline if you're smart about it. You're able to leave pretty quickly. And I think that's a realistic timeline. So that's what I'd keep in mind too, is a lot of this stuff, if you're smart about it, you're able to do it earlier. If not, it takes way longer. And you really don't want to put yourself in a position where you're kind of stuck early on because you didn't do the work while you're still at your job, and then you have to do it while you leave. And then you're in a tough spot. All right. And then just going into the deal itself, right? The reason I knew it was such a good deal is because I had done deals before. I had that experience. So I think a lot of people don't have that either, and they expect to do a home run deal in the first deal. That's not how it works, because you don't even know what to look for, right? So you need to do the earlier deals so you know what to look for in the better deals. And I think that's another thing too. So the main thing you want to focus on in this section, on just the backstory that I think you can apply to yourselves, because that's really what you're trying to do here, is it all compounds, right? So the earlier you start, the better. Even if you do a mediocre deal to start, it's fine. You're like, I would rather do a deal that I sold 5 years from now for the same amount than wait 5 years to start. It's a totally different ball game. And one of them you're in the game, the other one you're not even playing. Cool. So going back to the deal itself, right? I think one of the most important parts of this deal is picking a market. And I think a lot of people look at picking a market, in my opinion, completely the wrong way, right? So what most people focus on are the statistics, right? They're going to focus on population growth, unemployment rate, all this stuff, crime rate, schools, median income, whatever, right? You could toss 100 other statistics in there, they'll look at those too. And I'm not going to say these aren't important, but what I think this misses is that that's not how you make money in real estate. You don't make money because the population grows, right? That's not actually how you make money in real estate. If there's a low unemployment rate and it drops even lower, you don't make more money, right? That's not how it works. The only way you make money in real estate is if your stabilized yield is above the market cap rate. That's it, right? So that's what I focus on when I look at markets. I look at markets where I can actually find the spread. And I think this is one of the other things that I see most beginners struggling with, is they're looking in markets where they can never find a deal. Like if I were looking in New York City or LA, San Francisco, any of these major markets, there's a 0% chance I would have found this deal. Literally 0% chance. So you have to set yourself up to succeed. And the way I view that is you focus on the things that actually make you money, right? And this is the only thing in real estate that makes you money, just math. And I'll show you that on the next slide, just pure math. So I'm not going to say these things are unimportant. I think you want to look at this later on once you've kind of qualified for a market with a spread here. But this is not how you make money in real estate. Focusing on this is not going to make you money directly at all. Maybe you'll get lucky with rent growth, but that's not the same thing as actually being smart and underwriting correctly. So that's really what I would focus on. And I think that's one of the biggest mistakes people make is they end up in these major markets where they're betting on something like this, which, look, it may or may not pan out, or you can be sure you're going to make money because you know there's a spread. So that's what I would focus on. And if you look at it right here, I kind of have an illustration of this. So the top part of it, basically, you can see there's a spread between your stabilized yield and the market cap rate, and that leads to a profit here, right? Anytime you have a spread between your stabilized yield and your market cap rate, you're going to make money on the deal. In the bottom one, you can see the opposite. Basically, all that changed is the purchase price went from 5 mil to 7 mil, and now you're losing money on the deal. Right? So just to illustrate, I know very basic illustration for a lot of you people who are in the market, and just to backtrack a second, I know I went over the stabilized yield and market cap rate very quickly. Market cap rate is basically the average cap rate deals sell for in the market. For people who aren't familiar with cap rate and they're coming from another business model, such as kind of the private equity side, it's the inverse of an EBITDA multiple. So basically a 5% cap rate is the same thing as a 20x EBITDA multiple. Same thing. So what you're doing with a stabilized yield is you're basically getting your cost above the market. Basically, you have a cash flow stream that you have at 9% that the market's willing to pay 7% for. And that's why you make money. It's really, really simple. Your stabilized yield is basically the NOI divided by all your costs in the deal, which are right here. So it's a very, very simple formula. But that's basically how it works. And that's what I would focus on. So I think a lot of people end up focusing on the things that don't matter. You can see mathematically, this is the only way to make money in real estate. That's it. If as soon as this stabilized yield drops below the market cap rate, you're no longer making money. So if you're vetting a market doing something other than this, it's kind of pointless because you're looking at something that's downstream of the thing that actually makes you money. So just really want to hammer that home because I think it's incredibly important. And I think that's really one of the correct way to choose a market that I think almost no one does. I'm the only person I've ever heard talk about it like this because everyone else is going to throw statistics at you that personally I think don't matter at all. I didn't even look at the statistics in my market for this deal. But that's really how you do it. What I will say, and the kind of the next question is, how do you actually find markets that have this? The way you do that is you underwrite deals in the market. So if you're looking at a market, I would underwrite 5, 10, 20 deals, whatever you can get your hands on, and see if you find the spread. Right? If you find zero spread, the market's probably too tight, you move on to the next market. If you see a market where there is a spread, then you stay there. Right? So it's very simple. It's a very practical process rather than kind of like the hocus pocus of here's a statistic. And I think that makes it a lot easier. And I know for a fact that leads to deals that are way better. So you're never going to find a good deal in a market where there's no spread. You're just not. Cool. So really the next part of the process is establishing investment criteria. I like to call this a buy box. You could do this formally or informally. Basically what I like to do is break it down from the top. So what position do I want to be in the capital stack? What asset class do I want to be in? What product class? So like class A, class B, class C. The deal type, kind of like core plus, opportunistic, value add opportunistic. And that's basically just where you want to be in the risk spectrum. So core plus would be like really safe side. Opportunistic is really aggressive. Maybe you're doing a development deal. Then the market, sub-markets, market basis, and market cap rate. So market basis is basically the average price per unit or price per key that deals sell for in the market. Incredibly important, just because you need to figure out kind of where other comps are trading. And an ideal deal for me is a deal where not only are you buying currently under the market basis, right? Basically, let's say the average sale in the market is 100K a key, right? You want to be buying below that, obviously. So let's say for me, you'd rather be at 60K a key. And even more so, you'd rather when you model your sale to the next buyer, you want that to be below the market basis as well. And to me, that's a total home run. That's not possible in every single deal. But that's how you know you've really hit it out of the park is when you're modeling your exit to the next buyer at a lower market basis than the current comps are trading at. So that's one thing I really, really look for when I'm kind of going through the buy box process. Next is market cap rate. We discussed this earlier. This is really all in the details. You kind of need to take a ton of comps into account and understand exactly where the market cap rate is for a specific market. So you could just see what the multiple is deals are trading for. That's all you're doing. And obviously, once you see that multiple, you basically want to get a cash flow stream above that and have people pay you for it. So that's all that's happening there. But I will say this is an incredibly, it seems simple, but it's actually an incredibly detailed process once you get into it. And I think it's really helpful to actually write this out and just be like, look, here's where I want to be in each one of these specific things. And you'll notice that it really creates a funnel. And that's the idea, is you have a funnel that's very dialed in. So that does two things, right? One is it makes sure you don't buy a deal that doesn't make sense, right? It's almost impossible to do a bad deal if you know the exact, every single one of these criteria down to the market basis and market cap rate, right? It's nearly impossible to do a bad deal if you know exactly what the market basis is and the market cap rate is. The next thing is it really helps you know when to pull the trigger on a great deal. So if you see a deal like this deal, for example, right, I ended up buying it at around 60 a key. I knew for a fact deals in the market were selling that day for 90 to 100K a key. I came in at a 9 cap. I knew for a fact the market cap rate was 6.5. You know for a fact you're hitting a home run day one. So that's another thing, is it really takes away the risk of investing in real estate, because when you're coming in on that strong of a basis, you just know you're going to make money. And I think that's another thing people get tripped up on, is they'll be like, hey, you're taking a ton of risk by doing this deal. It's like, no, I'm not. Like, I would put every single dollar I have into this deal, right? Because I know it's going. I know where it's going, right? There's almost a 0% chance of it going wrong. So when you have this funnel really that detailed, it helps you make those decisions, one, to not make a mistake, and two, to know when to pull the trigger, which is kind of the goal. All right, so on to deal sourcing. This deal was sourced off market through a broker. And I like to kind of group everything into on market and off market. On market, you're kind of looking at deal aggregation platforms. That's LoopNet, Crexy, stuff like that. That's typically where most of the deals are, the bulk of them. You can also be on market through brokers. I would really suggest getting on every broker's email list in the market and just making sure you're seeing all their deal flow. Then you have the off market stuff. Off market through brokers, mailers, cold emails, cold calls. I would say that's most of it. There are other opportunities as well. You can do joint ventures, stuff like that. But we'll just talk about kind of this stuff for the time being. And this deal was sourced off market through a broker. I think a lot of people think you need this like really advanced broker relationship to get sent a deal. That was not the case here at all. I had interacted with this broker once in person before. Basically looked at an office condo deal that made no sense, told him it made no sense, and then just kind of kept in touch with him, emailing him. And I'll show you the emails in a second. But basically, that's all that happened there. It wasn't a really detailed process. We didn't know each other for 5 years. I think we knew each other for maybe it was a year. It could have been under a year. And that was really it. So it doesn't need to be a crazy good or crazy long relationship. But what you do need to do is convey exactly what you want. So basically, I had conveyed him all the details in this buy box. So he knew exactly what I was looking for. And that's what made it easy, right? You have to convey that, one, you're a legitimate buyer, and two, that you have criteria that actually make sense that they can kind of act on. And I think that's what I was able to do very well in this situation, which led to this deal. So it allows you to kind of bypass that whole, whatever you want to call it, long time frame of knowing someone, if you're able to kind of convey the legitimacy and your actual criteria. Cool. So the deal itself, and this is one of the biggest questions I get, is like, how do you know if it's a good deal? Like, what jumped out about it? So there are a few things here. First are kind of the numerical things that jumped out. And I talked about this a bit earlier on. And the next are really the market driven. And then there's kind of just some other stuff that jumped out as well, kind of intangibles. But from a numbers perspective, right, the basis was 60K a key. And I knew for a fact every asset sell for 90 to 100K a key. And if you think about that, right, you're coming in with 75% debt. So that's 45K a key in debt. So you're only putting in 15K a key of equity. You're basically at a 3X, right? Because you have your 15K, and then let's say you sell it for 90K a key, right? That's 30K there. So you're basically getting 45K a key back out on your 15K a key equity. So the day I bought it was a 3X. And I think that's what a lot of people don't understand in these deals, is it's possible to have something where it's that dialed in, where you know I'm getting a 3X the day I buy it. So you don't need a market lift. You don't need anything like that. In this case, you'll see that the market actually completely petered out and killed us. And we were still able to kind of execute on this business plan. So it's really all done at the buy, right? The day I bought it, I was pretty much coming in at a 3X multiple on my equity, which is pretty crazy. The next thing is the in-place cap rate, right? So in-place cap rate was 9%. in a market where the market cap rate was around 6.5%. That's a 250 basis point spread. That's pretty incredible at acquisition. To give context, I mean, typically you're looking at in a value add deal, typically you're coming in at a really, really low in place income, right? Which makes it way riskier of a deal because you basically have to place debt on it and get the income up to where it needs to be, which kind of leads to that risk. In this case, that wasn't the case, right? We're coming in with really high in place cash flow. We're not taking a lot of risk at all. And that's shown in the DSCR, which is basically the NOI divided by the debt service for the year. And that was 2.2x, which was extremely high, right? I would say if you look at it from a bank's perspective, they're typically looking for a 1.25x multiple, 1.25x DSCR multiple. I would say a great deal is like a 1.4x. We were at 2.2 to start out, which is pretty insane. So this is pretty incredible from a risk profile perspective, not only from an eventual return perspective, but we also weren't taking a lot of risk to get there because the in-place cash flow was so high. So those are kind of the three numerical things that really stood out to me about the deal. From a market perspective, there are a few things as well. Basically, the market was really, really undersupplied. There was almost no actual apartment supply in the market, all single-family homes, which to me is very attractive, right? You're in neighborhoods that are actually nice. And it's almost impossible for new supply to come in because no one wants a new apartment building next to their single-family home. So that was the first thing. There's also a lot of retail and hotel development kind of in a commercial sector down the road, which helped as well. And then kind of on the intangible front, it was off market through that broker I knew. I knew the broker wasn't that smart. I knew he mispriced assets. Doesn't mean it's a good deal, but it's higher likelihood of a good deal. Sellers were also long-term owners. So in this case, I mean, these sellers, some of these leases were from the 90s. I think there was one from like 97 that just had never been increased. So you end up there's a lot of kind of room to run without doing anything even remotely intelligent. You can just kind of hike rents immediately day one just because of where it was. The other thing I'll say is that a lot of the leases were month to month, which allows you to really increase rents almost immediately. So this is the initial email we got. You see, good afternoon, George. That's my business partner, George. So he was the one who received the email. But you'll see here that $234K was the income to start out. Obviously, we're buying it for 2.6 mil, $234K of NOI. So really, really high in-place income. I think it was actually $240K too. I think there was a mistake there. But overall, really high in-place income, which made the deal really, really easy, right? Just from a risk profile perspective. And then the other thing I want to note here is just how quickly we were able to go through the deal. So got the initial email on May 20th, hammered them with questions kind of immediately, set up a tour, submitted an LOI within 24 hours, had that signed, and then had the contract executed June 3rd. So we were really, really quick on this deal, as quick as we could be, just because we knew how good it was. So when you see a deal like this, you have to move extremely quickly. There's really zero reason to start haggling over price. I don't even think we haggled. I think we came in at like 255 or something, just to seem like we weren't giving it to him, just to seem like there was something there. But overall, I mean, we didn't haggle a thing. You basically want to get these under contract as soon as possible, get it under your control, and then move from there. So you really have to be fast in a situation like this. And what allows that is knowing the market well enough, which is kind of what we went over before. Once you create that buy box, you know immediately when you need to buy. So here are the closing costs. As you can see, it's like just around 2% or so of the purchase price of $2.6 million. Nothing too crazy here. What I will note is so many of the closing costs are lender related, like this appraisal here, the loan fee, the lender legal fee, all of that. It's all lender related. So if you actually if you're able to take down a deal with seller financing or something like that, you can drastically reduce the closing costs because half of the closing costs are essentially due to the lender. All right, so moving on to the structure. I think the structure is incredibly important. This is something I think a lot of people are not good on, just because they don't have the expertise to know how to structure a capital stack. But you can really, really kind of alter how much money you make in a deal if you can structure a capital stack correctly. So in this case, here are the sources and uses, right? Basically $2.75 million total, $1.95 million of debt. That debt was 4.25% interest only, 25-year amortization. It was interest only for a year, sorry. And then 25-year amortization. So basically 75% leverage. So pretty standard debt from a bank. It was a community bank, local bank there. And as you can see, purchase price 2.6 mil. Had some reserves in there, barely put any renovations in because the cash flow was so high. And then just the deal cost, which ended up being around 41K. So we had some savings there. The next part is really just the breakdown between LP and GP, right? So the GP is basically the sponsor. That's me and my business partner. That's what we put into the deal. So as you can see, we're only putting in 280K, which is 10% of the total capital stack, right? This 2.75 mil. Overall, though, it's 35% of the equity. So 35% of the 800K equity we're putting in was us. But with our structure, we're able to control a lot of the deal. And it's just a standard kind of private equity structure. But basically, the way we had this was we got a 20% return over a 10% IRR, and then a 30% return over a 30% IRR. So that last hurdle is a pretty high hurdle, but obviously we were able to hit that because we were at 145% IRR. So essentially, I mean, we put in 280K and we're able to control roughly 55% of the deal with the profits by the end of it because of that 30% profit share. So it just goes to show you really how much you can stretch your money in a deal like this. And even if we put $0 in, right, we would own 30% of the profits, which would have been around $1 million. So you can really, really do deals like this with very little money if you know how to structure it correctly. And that's really not even accounting for any of the other fees, right? You can have acquisition fees, asset management fees, construction fees, or development fees, whatever you want to call it, and everything like that. So once you kind of factor those fees in, you structure a deal correctly, you can easily be at a point where you're looking at basically a 3x on just a mediocre deal. And to walk you through that math, just basically, right, let's say you're looking at $1 million deal, right? And in this case, we put in 35% of the equity. Most of the time, you're putting in 10% as a private equity GP, right, which is just general partner. LP is just the investors, the equity here. Say you're looking at $1 million deal, right? And you're doing 75% debt, so that's 750K. The rest of it's equity, which is 250K, right? So an acquisition fee of 1% gives you 10K, right? Then you have a asset management fee of 2% of the equity per year. Let's say it's a 3-year hold. So that's 5K a year. That's 15K, right? So you've already made 25K without the deal even starting. You're putting in 10% of the equity of 250K, which is 25K. You basically have 2x your money the day the deal starts, even if there's no profits. So you can really, really start kind of juicing your money, obviously, with this structure. And that's why it's such a profitable structure. So just goes to show you, I mean, you can really do these deals with a smaller amount of money if you want to. Obviously, I think if you have a great deal, you want to put as much in as possible. And that was actually a huge mistake we made on this deal, is we had the money to do it, but we just assumed we'd see a ton more good deals as time went on, and we didn't put a lot into this. So that was actually one of our regrets, is we could have easily taken this down ourselves and didn't. So in a deal like this, I would always say, take as much down as you can. Cool. So here's the business plan. I really want to stress that the business plan is incredibly simple. Like in a deal like this, you make your money on the buy, right? The way I look at it is you want to buy so well that a monkey can operate the deal afterward and you still make money. So anyone who thinks that they have an operational edge in multifamily, I think is out of their mind. Everyone's doing the same thing. It's not difficult. Like you can look at any of the real estate dynasties and like their dumbest son still can't mess up a multifamily portfolio. So you're not changing anything. It's not difficult to do. You make your money on the buy, right? And that's why that whole process I walked through is so important up top, and why choosing a market is so important, is because that's really where you make all the money. The business plan itself was really simple. If you remember, we basically bought 44 of the 48 units to start out. So in this case, only 4 units left to buy to get full control, right? So that took a little bit of time. It wasn't difficult. We ended up buying them for, on average, 85K a key or so. But it was important, right, for a few reasons. The first is that it just makes it a cleaner deal, right, for the next buyer. Because no one wants to buy a fractured condo deal. They want to buy a multifamily deal, right? And when you give them the full 48 units, it gives them the option, if they want to turn that into a multifamily deal. They can dissolve the association and do that immediately. So that's the first thing. The second thing is you actually get access to way better debt. Basically, on the fractured condo side, you don't really have great debt options. And it's a huge pain actually to deal with banks because they don't fully understand it. They have to look at the condo docs and everything like that. It becomes a hassle. So it gives you better debt, which actually lowers the kind of the price, or increases the price people are willing to pay, lowers the cap rate. So So that's really why this was important. It wasn't that important from any other perspective in terms of like increasing the NOI. It was important to make the deal cleaner for the next buyer so they pay up for it. Then next thing was really increasing the in-place rents. And I think this is one of the things that I don't see many people talking about. But basically, there are two types of market rents. One is the unrenovated market rent. One is the renovated market rent. I like to look for deals where the unrenovated rent is below market, right? So basically, that means you don't need to put any money in to get that up to market rent, because for an unrenovated basis, it's still below the market rent. So that's what I'm mainly looking for in my deals, because that means you don't have to do any work. There's obviously the renovated market rent as well, which we kind of talk about in the third point here. But these rents were $700 acquisition. Like I said, some of these had not been bumped since the 90s. So we thought we can bring this up to like 1,000 or so, kind of day one. And we figured out actually as time went on that we could bring them up to almost 1,200 on unrenovated basis. So I do think we got a little bit lucky in that point with just the rent growth. We probably got like 10 to 20% rent growth that we didn't expect. I'll argue, and you'll see this in a second, that got negated by the fact that interest rates rose 300 basis points. But overall, we did get a little lucky on that, and I think that boosted the returns a bit. I think everyone kind of got that rent growth. Then the renovations, right? We only renovated 8 or so units. I think it was 8 on the nose. And we didn't put much in. I'll show you the renovation scope in a second and exactly what we spent. But we were putting in around 13K or so into the renovations, 15K sometimes if there's more work that needed to be done. So not too much. We funded that all through cash flow. So we didn't fund any of that through equity, through new equity. We were able to fund it all through cash flow because the deal was so high cash flowing, and we were able to have that first year of IO debt, which helped as well. So actually the remaining condos that we acquired too, we did that all through cash flow and additional loan proceeds. So we didn't put any new equity into the deal, which really juiced our multiple overall. So here's what they look like before. Obviously, like typical Class C units, I would call them. Nothing special, right? Really, really basic stuff. Like I said, small units around 400 square feet. This is what they turned into afterward. So I think we did a pretty good job for 13K. I mean, you obviously hit a point where they're not going to pay any more rent for putting more money in, just in this asset class. But stainless steel appliances are generally a nice touch kind of in this segment of the market. And I think we're able to do pretty well with that. This is what it cost. The one thing I'd point out here is we had a on-site super, which really reduced our labor costs. So we didn't have to go through kind of basically the unit cleaning and the unit prepping. So anything like sort of paint, even putting in floors, stuff like that, we're able to kind of do with the property manager, which really saved us money and allowed us to kind of hit this 13K number, whereas normally we'd probably be in the higher range around 15K with normal labor costs. All right, so moving on to the disposition here, right? Disposition, for those who don't know, that's just the sale. We had a ton of trouble with the sale on this, mainly because of market conditions. So we really got hit by the interest rates rising. When we sold it, the NOI was 540K. So we sold it for an in-place 8.5 cap. We thought we were going to sell it for a 6.5 cap. But as you can see here, I mean, interest rates rose, I think it was 300 basis points during the hold, which was pretty crazy. I think it negated pretty much all that rent increase that we got. So that was a real pain, right? And what really killed us too was this holdup here. Basically, we got the first 3 condos month 6. It took another 3 months to get that final condo. And during that time, the market really worsened, rates kept going, and that really extended out the process here because we wanted it to be a 1-year hold, and it ended up extending into a 22-month hold. So it really killed us those extra 3 months, but there wasn't much we could do. I mean, we could have basically forced the condo association to dissolve, but that would have taken a lot of time legally, and it really wasn't the best option at the time. So we did get a bit killed by the market here, just from a time perspective, which hurt our IRR, and from a perspective of that cap rates actually increased, which hurt our returns. So that did actually hurt us a bit. The other thing I'll note here is we actually had 2 failed sale transactions. It was under contract and they fell out of contract, mainly because interest rates kept going up and they couldn't get debt at the right rate or where they had modeled it. So that actually fell out twice. It wasn't a smooth transaction at all, but it just goes to show you if you have a great deal, it doesn't matter. Like this was probably the worst time to buy. September 2021 was probably the worst time to buy in like the last 15 years, right? Based on how cap rates rose. And we were still able to get a 5x return during that time. So I think two things there, right? One, everyone has this idea that you only make money when cap rates go down. That's a total myth. If you're horrible at real estate, yes, you need cap rates to go down. If you're good at what you do and you underwrite correctly and you have profit day one, you have that spread day one, you'll still make money if interest rates go up. Obviously, it's not ideal, but you'll still make money. The other thing is just the whole idea of just waiting for market conditions, I think, is the dumbest thing ever. And you see this all the time, like, oh, now's not a good time to buy, right? It doesn't make sense, right? You can have a good deal at any point in time. And the way I like to think about it is it's always a good time to buy a deal if you know what you're doing, always a bad time if you don't. So I'm never in that camp of, oh, I'm not investing right now. Because I think if you find a great deal, you have a great deal and you're going to make a ton of money on it. Obviously, there are certain points where we want to be more careful about what deals you buy. But overall, it makes no sense to be out of the market. I would never be out of the market just because of stuff like this. So here are the overall deal returns. So starting off here, basically what we went over before, 2.6 to 6.4 is the timeline. This is where we took the in-place rents, this from 700 to over 1,200. The NOI, you can see, doubled here. Importantly, you see the stabilized yield, right? Like I said, we thought we were going to sell for 6.5 cap, and we thought we had a 250 basis point spread to start out. We brought this up to an 18% stabilized yield, which I don't expect that on every deal. That's pretty absurd. To put that into context, I mean, I would say most private equity firms are looking to stabilize at 6 to 8%, which would be a good deal for them and looking for 150 basis point spread overall, maybe 200 basis point spread. I would say anytime a deal hits 10% stabilized yield, you have a total home run. This one ended up at 18%. So like I said, I mean, this is really an incredible deal. I wouldn't expect that on every deal. I think you can consistently do over 10%. 18% is definitely high. And I think we got a bit lucky with some of the rent increases. But like I said, day one, we basically bought this and it was a 3X. So we really did the job on the buy. Other thing I'll point out here is just how the returns kind of flow through, right? So the project level returns are 5.2X. 145% IRR. Basically, when you move to the GP, which is my returns, and like I said, I have a business partner, so this isn't all mine, right? But basically, the multiple ends up being 7.4, and the IRR ends up being insane, right? So this is just kind of the power of when you have it structured like this, you can end up with massive profit without putting much in, right? We turned 280K into 2.1 mil essentially in under 2 years, and really should have been a year if the market didn't kind of kill us. So I would kind of look at deals that way. And when you're able to raise the money, you can really, really juice the returns. And obviously your LPs do very well as well, right? They had a 4X return net, so no one was complaining. But the real money's on this side where you actually get the juice of the promote. Well, so what now? I mean, basically the way I look at it is I've set up a system where I can keep doing deals like this, right? And I don't think I could do 100 of these deals a year, but that's not really what I look for. The way my firm is set up is I just look to do 1 to 3 home run deals a year. And I think so far I've been very good at doing that. And I think it's very possible. Basically, you create a process, you create a system, you set the investment parameters, and you kind of let the deals flow through those parameters. So that's kind of how I look at it. That's what I did on this deal, and that's what I do moving forward. I mean, right now my pipeline has a 500 unit deal, a 200 unit deal, RV park, and a 25 unit deal. So kind of all over the size range, but it's you're kind of starting to see distress actually right now. I would say the 500 unit deal is 70% vacant. The 200 unit deal has a huge, basically the partnership is being sued. So that's kind of a partnership kind of distress level. The 25 unit deal is 50% vacant, and the RV park is like buying like a 2 cap, just a total disaster operationally. But I would say right now I'm seeing a lot of that kind of distress finally flow through the system, which is really nice to see and which is pretty enticing. But this is really why I started the acquisitions bootcamp, right? Is I created a model based on deals like this so other people can do them as well. And I'll get into that in a second. But basically what it is, it's an 8-week program where you work one-on-one with me or my business partner, George, right, to create an investment strategy that fits your skill set, your resources, and your goals. And we find a deal to fit that strategy. So the whole purpose is for people who are either struggling to start, right? Maybe they don't know where to start. They don't have a plan. They don't know how to underwrite. Or owners who are kind of in a spot where they have a few deals, but they don't know where to go next. That's really who we work with. And the whole idea is we create that business plan with you, and then we find you a deal. So how it works mechanically, right, is it's basically split into 2 4-week segments. The first 4 weeks are really about the learning aspect and getting you up to speed on, one, getting your buy box, right? So what I start out with is developing your own profitable strategy. And that's really creating that buy box. I think it's pointless going out in a market without a buy box. I think that's what most people do. That's why they never find a deal. Just because they're running around like a chicken with that its head. You need to do, first thing right out of the gate is developing a profitable strategy. Second week is all about learning how to underwrite a deal. So underwriting it so you actually know when to buy a deal. That's the goal of that week is, all right, here's when you know, here's when you buy. And then week 3 is finding a market, basically going through in a really granular detail what I went over of how to actually find a market where you can be profitable. And I think it's very possible. I think most people are just in the wrong markets to start out. Week 4 is really all the aspects of the closing process. So closing timeline, due diligence checklist, all of that, really very, very detailed and getting you to the point where you know exactly what you need to know to close. And then from weeks 5 to 8, we move into the practical, right? Learning how to move from learning to finding your deals. So you're out in the market, you're underwriting deals, you're bouncing it off me, and we're kind of understanding what deals make sense, when to pull the trigger, and we pull the trigger if the deal makes sense. So what it actually does is a few things, right? One, it teaches you how to identify markets that actually make sense, right? These are the markets institutions overlook that you can actually buy deals in. You're not going to buy anything in New York. You're not going to do it in San Francisco. All these markets don't work, right? You need to find markets that actually work where you can make real money. There are plenty of them across the country. They're in every state. The next is really an acquisition system that teaches you when to say yes or no, right? So I think a lot of people don't know when to say that. And this gives you a very, very clear idea of here's when I'm saying yes, here's where I'm saying no. Next is really deal sourcing, right? Figuring out how to create that funnel so deals really come to you. So they're basically coming in passively, right? I don't think it's possible to have passive cash flow, but I do think you get a passive deal flow, right? And basically the idea is deals come to you and you kind of work through them. Next is how to structure the deals. This is one of the biggest issues I think people have is their structure is completely out of whack, right? If you don't know how to structure a deal, you're probably leaving tens, hundreds of thousands of dollars on the table on every deal. So it's really how to structure the deals, how to make it so that when the deal hits, you make a ton of money. Next is really the deal funnel, right? So like I said before, creating that deal funnel where you actually identify the deals that will make you the most money. And then really the rest is being able to work one-on-one with someone who knows what they're doing, right? So as you're going through the process, when you say, hey, I might be making a mistake here, you can bounce it off me and understand, okay, here's what I need to do. And the last is obviously finding a deal. That's the goal of this entire process is to find you a deal. And as you can see in the next few slides, we've done that very well. So here's kind of what it looks like in practice. This was as of the end of January, last time I looked. You can see deals all over the country, right? From $90,000 single family deals to $3 million 15-unit deals, right? So really all over the country, all over all the jurisdictions, medical office, industrial, really everything. We kind of look at everything and we tailor it to the person, right? So basically what we do is during that process in the first week is we understand exactly everything about you, right? So your strengths, your weaknesses, your goals, and we tailor a process that makes sense to you, right? Maybe it's medical office, maybe it's multifamily, maybe it's industrial. I don't think you know until you go through that process. Here are a few samples of people who have either under contract or closed. I won't go into too much detail here, but I do want to note a few things. One, this deal, really want to note just kind of the level of detail we go through. In this case, he was looking in his chosen market. This is Matt. He wasn't able to find a deal. So we actually went in there and found it for him. He ended up getting this 34-unit deal under contract. Very interesting deal, kind of like a converted school. And he was able to do that basically with our help. So that's kind of one example there. Here's another one I want to note. This is Matt, different Matt. He basically came in with the goal of being able to leave his job. So we basically tailored the program around that, looking for a deal big enough. In this case, we were able to find it. We were able to help him close on a $3 million multifamily deal. Next one here is this is Brandon. This was actually an industrial deal. So in his case, he had basically connections in the cannabis space. We said, okay, let's push you into the cannabis space. Ended up getting a 10-and go on a great industrial deal, which ended up going really, really well. And last one I want to talk about here is just a signed lease. When people have existing portfolios that they need to work with, these are people who are slightly more experienced. In this case, we were able to help execute a signed lease on an industrial deal that added a ton of value, around $250K plus of value to the property. So be able to kind of execute on all different paths there. Here are the commonly asked questions I get. What's the cost of the boot camp? It's $7,500. I think some people say this is a lot of money. To me, I think this is insanely cheap for what you're getting. If you think about it, most people don't know how to underwrite a deal at all. And if you're buying let's say you're buying a $750K deal, if you're off by 1%, that's $7,500 right there. So I look at it from two perspectives. One is we're saving you money on the buy. And I think almost every single time that I've seen someone go through the program, we've saved the money on the buy because almost no one has said underwrite correctly. So my guess is we'll save you way more than $7,500 on the buy of your first deal, never mind the rest of them. And then really the next is making money, right? So structuring a deal correctly so that you do make a ton of money on the back end. And in that case, I mean, I think knowing how to underwrite, structuring a deal correctly, most people will make far, far more than this. Really, the only way it doesn't pencil is if you don't end up buying a deal. That's how I look at it. The rest of it, yes, we do have payment plans. How much time should you allocate per week? I think it takes roughly 15 minutes a day. There are some weeks that take more. Once you get to the deal sourcing side, it may take more depending on how aggressive you want to be. Regarding the calls, all calls are taken one-on-one. So you're either talking to me or my business partner, George. We don't farm it out whatsoever. And we handle it all personally. Do we offer help once the 8 weeks is up? It's technically not part of the program, but I do. I'm more than happy to do that on an ad hoc basis if you need help underwriting a deal or whatever. I mean, my goal is to get you a deal. So I'm happy to do that. And I'm still in touch with almost everyone who's gone through the program, honestly. And the last is how many clients do we take at once? It's all one-on-one work. Like we really do not farm this out whatsoever. So we only take 30 clients at a time, first come, first serve. So if you'd like to apply for this, you can apply in the chat. There is a link to sign up for calls, really meant for people who are looking to buy deals now, right? And we'll tell you on the call if we don't think it's a good fit. I'm going to look through these questions in the group. I'll try and start from the top. How long back was the triplex? How many deals have you done since then? So triplex was back, what was that? 7 years ago or so, I want to say. Done a ton of deals since then across both at my company and other company. I don't have the exact number. Am I brokering deals in Northern Virginia? No. What's my typical spread that I'm looking for? I'm usually looking for at least like 350 basis points. So I have a different kind of strategy than most people. I think most people are looking for more of they're looking to do volume, right? So most people are basically looking for a 150 to 200 basis point spread, and they're building a really high AUM, right? They're basically AUM based shops. That's not what I do at all. I look to make the money in the promote. I look to do only a few deals a year, and I'm really only looking to do home run deals. So I'm looking for basically to stabilize above a 10 plus percent stabilized yield. And that generally leads to let's call it 350 basis point spread or so. So that's typically what I'm targeting. Will this webinar be recorded? Yeah, it's being recorded. It should be available afterward. How do you find the market cap rate for your area? So this is a good question. The answer is it's one of the things that's actually kind of difficult. And this is something we really go through in the acquisitions bootcamp because it's hard to get right. The easiest way to find it is looking for comps that sold that are stabilized properties. So that means there's no work left to be done on the property. That is basically a direct comp to the property, your property types you're looking at. That's the easiest way, right? Obviously, you're going to have a lot of comps that are value add comps, right? In which case you're going to need to do some adjusting for the market cap rate because obviously people don't buy value add deals based on the in-place cap rate, right? They're buying it based on the stabilized yield they can get to eventually. So it ends up being a process, right? Is basically how I look at it. And you basically average out all of the deals and try and find the market cap rate. I wouldn't say it's an exact science, right? And everyone's going to come to a slightly different number. I'd say most people, if you're looking at a market, some will be at 6%, some will be at 6.5%, right? It's rare everyone's going to be at the exact same number, and that's kind of the art of it. But the easiest way is if you have a stabilized deal that sells in the market, that's the easiest barometer. Another thing that's generally easy when they sell is if you have a deal that's a brand new build when it sells. that's very easy as well, because that's always fully stabilized. You're going to come in at a lower or higher cap rate than that on other deals, obviously, because that's a new build. But that's another really easy way of doing it. But overall, it's getting as many comps as possible. Typically, you're getting, let's say, anywhere from 5 to 20 comps and running it that way. So that's really what I would say is the way to do it. And it takes a bit. I would say it probably ends up taking 5 to 20 comps really to do it right. Did you rely on cap rate analysis for small multifamily deals you started with? Yes. So basically what I would say is I would never buy even a single family rental without doing that. So I think you want to look at it from every perspective, right? Single family is obviously very comp driven as well. And you'll look at it from a comp perspective. But at the same time, you also need to look at it from a cap rate perspective, right? Because you're buying a business, right? And businesses need to work on a cash flow basis. So you don't want to be stuck in a scenario where the cap rate doesn't work and you're actually stabilizing below the market cap rate, but like the basis looks good. Because basically what you have then is a hot potato that you need to sell to someone else. So I really, really would not do that. And I would look at it from both perspectives, even when you're buying smaller deals. You're saying stabilized yield depends on inputs, one of them being occupancy, and occupancy depends on unemployment rate. Yeah, see, that's my point, is that occupancy depending on unemployment rate is like a third derivative of the stabilized yield, when in reality, all that matters is the stabilized yield. So yes, I'm not going to say they're not important at all, but at a very high level, you don't want to be focusing on unemployment over the stabilized yield, because it's one of the factors that results in it. It's not the actual factor that makes you money. How do we find good deals when market deals are 5 to 6% cap rate? It depends on the market. I'd have to look at it closer to know. It could just be a bad market, or it could be a market that you're not looking at correctly. What questions did I ask the broker for this? I was asking the broker a few questions. Really, there's only a few questions that can actually swing the deal in a deal that has this big of a margin. First, I would say is CapEx, right? Any outstanding CapEx. That's very important. Obviously, that's going to basically come out of the purchase price if it's there. Second, which is making sure those financials are correct and making sure the rent roll is correct, because that's the next thing banks are going to ask for. And that was really it. That's mainly what we hammered them with. Everything else you can kind of figure out if you know the market well. So those were the only things we were really asking about closely, because that was the only thing that was really going to move the needle in a deal like this. How did you get a value of $2.6 million for the property? That was actually what they were asking. And I just didn't feel like negotiating because I thought it was such a good deal. And I would highly suggest that if you have a really good deal, is not to be like don't start getting ticky-tacky with it. Like, just get it under contract. It doesn't matter if you make another 100K or not in the deal, right? Because this deal we ended up making, I forgot what the total profit was, 3.3 million, right? So who cares about 100K? Jason, what if the condos didn't want to sell? That's a good question, right? So we owned 80% of it, more than 80%, obviously, because we owned 44 or 48. So it didn't really matter if they didn't want to sell or not, because what we could have just done is dissolve the association and force them to sell to us. So I didn't want to do that. I was trying to go the nice route initially. Obviously, that ended up costing us because it took extra time and ended up resulting in kind of the interest rate rise and everything like that. But that's what you can do. I think you're in a lot of trouble if you buy a fractured condo deal, don't own that number. And by the way, the 80% differs based on what state you're in. You don't have that control, then yeah, you're in a lot of trouble and you can't force them to sell. And that's when it's a dangerous deal. What does your day-to-day or week-to-week look like in terms of the way you break up your time and the resources you're using for scouring for deals? So I probably end up spending 3 to 4 hours a day, I would say, looking for deals. It really depends on what point you're at of the deal process. If you have a deal that's under contract, obviously you're going full bore on that front. That's not always the case. And when you're not kind of under contract, you do typically have a lot more time. So it kind of depends. And I would say it's very not linear, right? I'll have points where I'm sprinting and you're working 70 hours a week. Then I'll have other points where I'm working 20 hours a week and not really looking at much. So I would say I'm never out of the market, but there are definitely points when deal flow kind of slows down, and it's up to you if you want to kind of hammer brokers or just hold back a little bit and hang out. By the way, I took the course and learned in 6 weeks. It would have taken me 12 to 15 months to figure out on my own. Thanks. Yeah, I appreciate that, Adam. Do you teach how to raise capital and the legal documents around that? Yes, I do. What I will say is you always need a lawyer for that aspect of the process, just because you're dealing with raising money. You're dealing with a lot of regulations there. But yes, I do teach kind of exactly how to do that, the way I do it too, and how you really want to structure things there. Are you helping clients raise capital? No, I'm not doing that. I basically, in the first week of the process, basically what we do is we understand what everyone's kind of access to resources are, and we work within those parameters. So I'm not helping raise capital or anything like that. I think it would be very difficult to do that effectively. And we wouldn't be able to see the success we've seen if we did it that way. Are you finding good deals in Florida? Honestly, I'd probably stay away from Florida right now. Just the insurance costs, the CapEx, everything's out of control there. I would probably stay away from it for the time being until everything settles, but that's just me. I still think I do know people finding good deals there though, just as a caveat. Can we find such deals in today's market? I mean, I'll say the deals I'm looking at right now, I'm looking at one deal that's 500 units that I'm looking to buy for 20 mil. That would be 10 times better than this deal. So yeah, you can definitely find them right now. I will say like I said, there's a distress component to it. Right, it's not as clean as this deal. That one would be 70% vacant or so, which comes with a lot more risk, especially when you have a bigger deal like that. But yeah, I see plenty of deals right now. Do you recommend any Excel models? What are the 3 most important metrics? So I do. I have my own Excel models that I use. What I will say is I wouldn't go overboard with the Excel models. Right? Either you understand the concept or you don't. So I don't think a lot of the time people think, oh, I got this model, it's going to really help me out. Probably not. Right? You should be able to create any model you're using from scratch and then use it pretty easily. Regarding the most important metrics, stabilized yield is the most important by far, I think. Followed probably by basis, I would say. But I would definitely emphasize stabilized yield over basis. And I think the other one depends on the deal. I think DSCR can be important. It can also be very irrelevant. So the next one really depends on you have to look at the deal holistically. I'm not a huge fan of just looking at 2 metrics and calling it a day, right? I think you want to look at basically stabilized yield, right? Where are you starting? Where are you ending, right? And what is the risk you're taking to get there? And that's kind of how I look at deals more so than, hey, here are the 3 metrics you need to look at. Why don't you charge any fees, acquisition, AM, overhead? I do charge fees. What I will say is when you're in the smaller deal range, it's not going to make that much of a difference. Right, your promote ends up being so much bigger than your fees. If you start going with bigger deals, yeah, you make a ton of money off fees. But usually I'll charge 1% acquisition fee, maybe 2%, AM fee, 2% or so of the equity in the deal, and then not much else for overhead. We run a really lean shop. Oscar, would this be helpful for someone ready to buy but completely new to real estate? Yeah, that's pretty much who it's targeted for. I'd say 60% of the people or so are in that camp. And 40% or so are in the existing deals and looking to expand. Sam, have you ever worked with a Canadian client looking to buy deals in the US? Yeah, I have. I've worked with a few of those. I will say I don't deal with the whole international process, but obviously the process of buying the actual real estate and the underwriting, everything is exactly the same. So yeah, I have done that before. Taylor's asking, how do you find market cap rate in Texas where sales comps are not public? So a few different ways there. First, I think is the easiest is going through brokers. And when you go through brokers, typically they'll have something. So basically when you see a listing, just say, hey, I see you have it listed at 120K a key. Do you have any comps to back that up? Right? Really simple. Typically they'll have something. That's the easiest. If not, you can kind of go into have a friend pull something from CoStar or something like that. 2, start really talking to friends in the market who know comps. I would say that's the easiest way in those scenarios. You could also look up market reports as well. A lot of the reports, if you search multifamily market report and X market, they'll have a lot of comps in that as well. That's public information. Do you use tax advantage strategies such as cost seg studies? Yeah, I do that on every deal. How many deals do you underwrite per year versus offer on? I don't have the exact stats since I started running my own firm. I know previously when I worked at a different shop, it was roughly 1% of the deals that we looked at, we won. So roughly 1%. Eric, why do you sell? Majority of real estate investors argue you should never sell. I like spending money. I'm not one of those people who's like, oh, like my grandchildren are going to be rich. Like, I don't care. I want to spend the money and I like having fun. So yeah, that's why. Do students have access to analyze, consult on future deals post bootcamp? Yes. So basically what I will say is, like I said earlier, if anyone has any questions post bootcamp and they're like, hey, look, I need help underwriting a deal or something like that, I'm more than happy to do that. Like I said, technically it ends at 8 weeks because you need to have an end period, but I'm more than happy to help in any reasonable capacity. On the individual that helped find the school conversion, did you take any equity? No, I didn't take any equity in that deal. For the case study, when you improved the units, what did you base your confidence in that you could achieve the new rents? Was your leasing agent your only way to get it stabilized? We didn't use a leasing agent. We did that all in-house. We based it off a lot of different things. The first is actual rent comps that we pulled from brokers or from the MLS. So those are closed rent comps. Second is Zillow, apartments.com listings. Third is actually the HUD rents. So we were able to kind of triangulate all those and we're pretty confident in the rents we could get. How are you pivoting to other financing sources, assuming some local banks are drying up, especially in secondary and tertiary markets? I haven't really seen it fully dry up, to be honest. I think some lenders have pulled back. What I would say is if you're having trouble with financing, just use a debt broker. They're going to be able to find someone. Who are the typical buyers when you sell? It depends what range you're selling in. Like if you're selling in the mid-market range, 5 to 10 mil, you're probably looking at some like rinky-dink private equity firms and some high net worths. Do you think true novices to real estate would be good for the boot camp or should start off with a real estate God course first? Yeah, so I would say if you're starting, like I said, 60% of the people who've gone through the boot camp are true novices. So it's really the first 4 weeks are built around building in that skill set, even if you don't have it now. So yeah, it's definitely who it's intended for. You mentioned not relying on operational edges. How do you manage hire property managers and GCs when your experience is on the back end? Because it doesn't matter, right? Let's say I had whatever. Let's say the renovations didn't cost me $13K, but they cost me $17K, and I spent another, what is that, across 8 units, another $30,000. Who cares, right? Wouldn't have done anything to the deal. So if you buy with this big of a margin, your operations don't matter. So I'm not going to say like you don't do anything and you specifically let it go to shit, but like it doesn't really matter at the end of the day. Gavin, I've done the course, originally thought twice about the cost, which I realize now is amazing value. I basically saved 2 years of scrapping to find this info in a tailored package. Homework really drives you forward. Weekly calls are where the value sits. Appreciate it, Gavin. Aren't there other people looking at the same deal? What do you think they didn't see, given the deal seemed to be decently mispriced? No one else was looking at that deal. We got it off market beforehand. So that's kind of the benefit of an off market deal. I mean, maybe one other person looked at it. I don't know for a fact, but my guess is no one else looked at that deal. You mentioned that buying sooner is better than waiting. What advice do you have for making this possible for people in other industries, IB, PE? I mean, the same advice is given to everyone, right? When I was starting out, I was working 60 hours a week, buying deals on the side and running an online business. So like I think if you want to do it, you make it happen. I'm really hesitant to say anyone's too busy to buy a deal. I just don't really believe it. I think I work probably more than almost anyone. And I'm able to find time for almost everything. So I think it's about your priorities, right? If you want to leave your business early, if you want to start a business, if you want to leave your job early, you have to put the work in, right? There's really no way around it. So I don't think IB or PE is a legitimate excuse. I think if you want to do it, you get it done. How is the bootcamp structured? Phone calls, materials, online course? Thanks. Yeah, that's a good point. I think I skipped over that. So basically the way it's structured is there's a phone call at the end of each week, one-on-one, where we go over everything in the course. During the week itself, you're basically release materials. So Depends on the week. Could be videos, could be spreadsheets, could be worksheets, could just be readings, really to get you to the point where you kind of know what you're doing within that specific week. Whether that's the underwriting week, you'll be doing models and case studies, and then we just go over it all together. So it's really all synced up at the end of the week. You get to go over it all one-on-one at the end of the week, and it's a pretty good process there. What do you think about Canadian markets versus the US? I have no opinion on Canadian markets, really. I've never invested there. Eric, would you be willing to participate as an equity partner on a home run deal? Sure. I mean, I like making money. If you have a home run deal, I'm happy to take a look. Have you identified any distress opportunities or instances of delinquencies that you plan to capitalize on, particularly among the general partners who are heavily leveraged in 2021 or during the COVID era? Yeah, I've seen a lot of those. Like I said, my pipeline right now is pretty much all distressed. That 200 unit deal I'm looking at, one of the partners took out a fraudulent loan and now they're suing each other. So it's actually a 9 cap deal. The asset's fine. It's just a partnership that's distressed. So that's an example of a GP that I guess he took bad LPs. I don't even know how it happened. It was like clear fraud. But yeah, I'm seeing a lot of that now. If you had 40 to 50K, would you allocate mostly towards an FHA house hack, or spread across multiple deals with capital partners? Neither. I would find a deal and try and flip it. And honestly, if I was in that position, which I've been in before, I would raise money for the deal. But I would never spread it across multiple capital partners with that low of an amount. And I don't like the FHA house hack model because your quality of life sucks. I think you can find a good deal without doing that. How do you go about estimating rehab costs? Do you have a contractor, etc.? Yeah, I mean, now at this point, I just kind of know what they're going to be most of the time, unless there's something significantly detailed that needs to be done. Overall, I would say if you're looking at a 1-bedroom unit and you're doing a cosmetic rehab, I would budget like 15K or so as a barometer. I have a significant tax liability in 2 years or so. Which asset class might give me the best tax benefits considering depreciation and cost segregation? My guess is the highest is probably an RV park or mobile home park. That typically gets you the most depreciation. What do you think the right way to scale up is? For example, going from a duplex to 50 units seems wildly different. It's really not different at all. It's the same thing with just more units. So I think in this case, it's almost all a mentality thing, right? It's literally, I'm telling you the same thing. I've done it before. You're going to think it's different. And it's actually, what I would say is it's actually easier because you could pay for management now, right? When you have like a duplex, it's tough to pay for management. When you have a 50 unit building, you can pay for someone else to do it. So you can be the next layer above. So I would say a lot of the time it gets easier as you get bigger. Obviously the dollar amounts change. One thing I will say changes is you really have to capitalize your deals way more appropriately. If you're looking at like a 10 unit deal and there's a cash flow problem and you need to plug in 50K, is what it is, right? If you're looking at a 500 unit deal and there's a cash flow problem and you need to plug in 2 mil, you have a problem, right? So that's really the one thing that changes. I would say you really need to make sure your deals are adequately capitalized once you get bigger, because you can't just plug that gap very quickly. When we get to find a deal part of the bootcamp, do you bring forward deals to your clients or let the client source their own deals? So ideally you're sourcing your own deals, and that's not so I can do less work. It's so that you don't need me, which I think is the point of the bootcamp by the end of it, right? You don't want to have me doing all the work because then it's pointless for you, right? Because then you still need me to move forward. So I always try and get to the point where you can do those deals yourself. And I think I've been successful with that. But if you do need help, I'm happy to jump in and help in an ad hoc scenario. Yeah. If you live in a major city like Phoenix, Arizona, how do you decide what territory market to buy in? That really depends. I would have to look at what you're looking to do. I don't think that's a blanket answer. I think you need to understand what your goals are, what your risk profile is, and find a deal that suits that. So I would need to know that before answering it. What are your IRR hurdles in GP promote? Like I said before, so basically this deal was 20% promote over a 10% IRR, and then a 30% promote over a 30% IRR. So roughly that on every deal. I would say typically 30% is my top hurdle. What are your partnership distribution assumptions? Not sure exactly what you mean by that, but what I would say is typically we're not looking to distribute money at all during the holding period of the deal. And mainly the reason for that is that we have so many opportunities to reinvest into the deal. Like in this deal, for example, right, we can reinvest into buying the condos, and right, we're buying the condos for 85 key and selling them for 130 a key. That's a pretty good source of money, right? A use of money. By the same token, right, you're renovating a unit for 13K, right, and you're getting $300 extra a month on it, right? So that's what, a 30% or so return on cost. Pretty hard to find a better use of money, right? So usually we're not distributing during the hold period, just because of that. And the main distribution happens at the end. What strategies do you use to lower your capital gain tax burden after you sell? I mean, mainly what I'm doing is depreciation. I have real estate professional tax status, which helps a lot. I don't 1031 a lot, just because, like I said, I like using the money, right? I'm not one of those people who just plans on having their grandkids spend it all. So I use all the money myself. And the main way to mitigate that, if you're actually taking profits, is through cost setting and depreciation. I know you target tertiary markets, but is there a risk in the sale with not as many buyers? Is there something you could do to mitigate that risk, like broker relationship or networking with other players in that market? So I always hear this. I haven't seen it play out in reality at all. What I'll say is this deal, I think we had 10 to 15 people bid on it. I want to say the number was 12. So we had 12 people bidding on this at like the worst time to be in the market in the last 15 years. So I think it's kind of an overblown concern. If you can see right now, there's really not a liquidity problem at all either, even though everyone's predicted it. So I haven't seen that really borne out in reality. We had plenty of bidders on this deal, and we've had plenty of bidders on all of our deals. Have you done these strip mall deals? No, I haven't. I look at them sometimes, but I think it's a good niche to be in because it's very hard to underwrite retail. If you look at something like multifamily, for example, right, you basically have, if there's a multifamily building on one side of the street versus another side of the street, they're going to have the same rents essentially. Strip malls, that's not the case. You can have one on the corner versus one on the other end that it just could be wildly different rents. So I think it makes it a lot more difficult to underwrite, which is a good thing when you know the asset class well. But if you're kind of a visitor in the asset class, it's very difficult, I think, to be involved there. So I don't really touch it unless it's a home run, and I haven't seen a home run yet. I find it hard to find deals like this. Can you talk about how the program helps with finding such deals? I've done over a dozen deals in the last 5 years, but don't see any deals in Washington State. Brokers laugh and don't take us seriously for looking at a 7 cap or higher in place cap. Well, I think a lot of times it's not helpful to tell brokers that you're looking for a certain stabilized yield because I don't think they understand it. Typically what I do is I tell them I'm looking for a certain asset class, a certain size range, and a certain location. And I let them send me everything they have because I don't trust them to underwrite the deal. So I don't know without kind of hearing how you're working, what you're doing wrong. But my guess is there's a few things on the sourcing front you're not doing right. What font did you use for the slides? This is Garamond. Yeah, it's who uses this. I got it from one of my friends in banking who used it mainly. I'm blanking on the firm, but yeah, it's definitely an institutional one. Do you teach how to set up management in the properties post-acquisition? Yeah, I do. I mean, I wouldn't worry about this part of the process. Like, I think people really, really overblow it. It's not like a multifamily building is the easiest business to operate in the world. And I'm not saying that to sell a course. I'm telling you just because it is. It's literally the easiest business in the world. Obviously, you don't want to take it lightly, but it just is. If you can't operate a multifamily building, you cannot run any other business. So I think there are a ton of ways of doing it. I've done an in-house super who's done it before, kind of like a live-in super. You do third-party management, or you can manage it in-house yourself. There's a lot of different ways of doing it. It depends on your specific scenario. But I don't think that's I think people really overblow that part of the process. It's not, that's something that you figure out after you have a great deal under contract. Do you keep any deals for the cash flow or always sell? You could always refinance and take out dividends if you want to spend the money. Yeah, so you can, right? But you have to think about every deal that you take on, even if there's no such thing as passive income, right? So every deal that you decide to hold, you're spending some time managing it, even if it's not a lot. And that time just adds up, right? Like, let's say it's only 5 hours a week, which is nothing, right? That's still 5 hours every week that you're spending on that you could be spending finding a new deal, right? So it's very rare that the best way to use your time is on a stabilized deal. I would say it's almost never. So I'm always looking to spend my time on acquisition and not on stabilized deals. I'm sure there are scenarios where I would hold for the cash flow if the money coming in was actually extremely, like it was a high enough number. But I haven't seen anything that attractive enough yet to do that. How did you think about splitting responsibilities with your partner? So basically, I would say we do a lot of the same things together, and we don't have like a formal splitting of duties. I would say he's definitely way more organized than I am. He's also definitely a little bit more. I'm more optimistic than he is, which I think helps us work together a lot. But we're underwriting every deal together. We're sourcing deals together. We're doing pretty much everything together. We don't have like a traditional like, hey, I do this, you do that. I would say we do everything together, and really the true help is being able to bounce everything off each other, which I think is really useful as we move forward. I think people underestimate how hard it is to be a solo entrepreneur, just because you don't have that person who's like, hey, like, am I crazy here? Like, or is this a great deal? You know, and that happens to everyone every once in a while, even if you have a great process. So it's good to just have that. Where are you finding distressed deals? Honestly, all over the place. Some of it, like I said, a lot of it actually right now is joint ventures, I would say. So just people I've met in the space who either they need equity to help close the deal, or they just need an operating partner. So I'm seeing a lot of that right now, actually, more than I would have thought. Also, mostly through brokers. I would say almost all my deals are off market through brokers that are good deals. Some on market through brokers as well, but that's where I source most of my deals is off market through brokers. Do you buy or coach buying distressed debt portfolios? I can help with that. I mean, I would say it's not my strong suit. My business partner, George, he's focused on that at the institutional level. So I would honestly probably direct you to him in that scenario. But yeah, you certainly can do it. I think right now it's kind of like to some degree an overcrowded space. And really the only place you're probably going to find it is mainly on the office side, which you wouldn't really want it there. But yeah, I've done it before. Do you take outside investors as LPs in your deals? Not really from Twitter, no. I just kind of separated it so far, and I haven't really needed to raise from there. There might be a point where I do, but I just haven't done it yet. There's obviously a ton of regulations too. I just don't really feel like dealing with the whole process. How much savings or cash do you suggest candidates have before investing in their first deal, and why? This is like a difficult one because I think the advice I give other people is different from what I did myself. I did it with $2,500 myself. That was literally it. I think the average person, you probably want more than that. But once again, I think you'd also, like, if you want to do what I was doing, you do it with lower amount of money. I would say typically what I say is $50K that you either can raise or have access to just to make it worthwhile to do a deal, even in that smaller size range. But overall, look, if you want to do it and you only have a small amount of money, I'm not going to say no, right? If you want to buy a deal, like, you can make it work. It's just way more difficult for sure. There's no doubt about it. What's the point of forcing so much depreciation if you're selling in 2 to 3 years? Isn't there recapture anyway? Sales taxes off lower basis. It's just time value of money. So you end up saving it on that specific year and then just pay it later. So yeah, it's not like it's a crazy thing, but you do end up saving and you just don't have to pay the taxes immediately. Do you deal with land flipping and land subdivisions? What are your thoughts on that space? I actually don't do that, but I do think it's a great space to be in. One of my business partners, my mentor, he is in that space. He does very well in it, but I don't do it personally. I do think it's a good space to be in, though. Obviously, you own and operate out of state. How do you make sure everything is operating smoothly and PMs are not taking advantage of you? Like, how do you mitigate those disadvantages? I mean, I think it's really hard for PMs to take advantage of you because it's very obvious in the accounting if they are. So I do all the accounting, and you could just see if anything's happening. So I guess they could take advantage of you for like 2 weeks before you see the accounting for that month. But no, I don't really have any major problems with that because I think if you just have your eye on the ball on the accounting side, you're in pretty good shape. Have you ever done a new construction apartments? No, I don't do a ton of development. Just not really what I do. Honestly, I think I'm not totally against it, but I think the risk reward isn't really there. Like this deal is a 5x. I did pretty much nothing. Why would I bang my head against the wall in development to get a 2x? It just doesn't really seem to make a ton of sense to me. And obviously, not every deal is going to be like this, but I think I could consistently 2 to 3x capital over a 2 to 5 year period without doing development. So to me, it's kind of difficult, and really the only reason why I want to do it is scale or development fees eventually. But it's not what I want to do right now. What states do you recommend to find high cap deals? I mean, you can find them in every state. You can find a high cap deal in New York and California if you want, which are the two hottest states in the country. You're just not going to like where you're doing it. So, I mean, you could find it everywhere. I think you need to be careful about when you're in the worst market of the state. You probably don't want to be there, but there are plenty of deals. What I would do, go on LoopNet, search 7 cap and above in the state, and you'll probably see a lot come up. How big of a deal, multifamily or value, do you recommend should be the first deal? It's just so dependent on the person. Like I said, I showed you mine. Mine was $200K. Personally, the way I look at it is you want to do whatever you can do the quickest. So like if I had, let's call it whatever, 20 grand, I would try and do a 100K deal. You know what I mean? Just to get in the game. Because the way I view it is you make your money once you're in the game. So whatever deal you could take down with the access to capital you have, whether it's yours or others, that's the size I would start out with and start there. Do you need a good credit score when taking out loans for your first deal? So this depends if you're in the single family space or the multifamily space. Obviously, you don't ever want a bad credit score, but if you're in the commercial space, they're really looking at the cash flow from the deal more than they're looking at you. Whereas in the residential space, they're really looking at you. So you can kind of mitigate it a bit in the commercial space, but yeah, I think you probably need at least a 600 to get anything done. I'm sure you get this question a lot. What made you decide to start this coaching program? So to me, first off, I enjoy doing it. Second of all, it pairs really well with the way I set up my firm. So like I'm not always working. Like I said, I'll have weeks where I'm working 20 hours a week on the acquisition side. And I don't have to do a lot of deals because I'm set up very lean. So I'm looking to do 1 to 3 deals a year. That gives me a lot of downtime. If I had set up in a way to do 10 deals a year and be an AUM focused shop, it'd be a different story, right? And I'd have to kind of structure it differently. I wouldn't be able to do this. So it's really just the way I set the firm up. And I honestly think almost no one in the world is in the position I'm in because they set up their firm in a way that they have to keep doing deals. Otherwise they go under. And I'm just not in that position, which allows me more flexibility. My background is in land subdivision, dev. Why are you not active? Can you expand? It's just not a space I've done in the past. It's just not really where I started out, and I haven't been pushed in that direction yet. I might eventually, but like I said, I have nothing against the asset class. It just hasn't been a focus of mine. Should I expect to sign a personal guarantee? So this depends what debt you're sourcing, right? If you're bank debt and you're 70% plus or 65% plus levered, yeah, you're probably signing a personal guarantee. If you go the CMBS route, if you go the agency route, those are going to be non-recourse. If you use seller financing, you could also be non-recourse. So it depends what type of debt you're sourcing. How much of a down payment should you generally have? I would say generally you need 25% at least down. Right. There's certainly scenarios where you could be higher leverage and still be fine. And there are other scenarios where you'd want to be lower leverage. So I would say 25% or so is probably, let's call it 20 to 30% is pretty normal. Was this a forced sale? 2.6 million seems very low. Broker incompetence and pricing. Not a forced sale. This seller, I forgot to mention this, was scared about Biden's tax plan. I had no idea what she was referring to, but I was happy about it. It was really all broker incompetence and seller incompetence. How important is being in the market you plan on buying in? Important to be X hours from the asset. So look, the way I'd put it is ideally you're right next to the deal, right? Ideally you can go there every single day. Most of the time that's not the case. I live across the country from the markets I invest in, and it hasn't been too much of an issue. Like I said, it's not going to be ideal. But But for me, that's how I look at it. If you want to be in the good markets that make sense for you. And in order to do that, sometimes you're investing across the country. So I think ideally it's right next to you within a drive, at least a day's drive. But for me, I invest across the country, and I've been fine. Do you allow LPs to invest in your deals? I do allow LPs. Like I said, I don't really take from Twitter, just because I haven't wanted to deal with that legal ramification yet. I may do that in the future, but I just haven't so far. Is this webinar going to be uploaded somewhere to be rewatched? Yes, it is. I think it should be uploaded, and you should get an email about it. I don't know. It's an automated service. What's your experience with industrial? I have a fair amount of experience with industrial, mainly at the institutional level. I do look at a ton of industrial deals now, and a ton of actually self-storage deals as well. But yeah, I worked on that a fair amount, kind of adjacent to the office space. George worked on it a ton too at his firm. So yeah, we know it pretty well. When renovating units, how do you make sure costs are what you expected? I mean, look, you basically get the bid from the contractor. And the way I view it with contractors is you want to get multiple bids, right? Because the way you get screwed is 1, on price, and 2, you get screwed with them not doing the work, right? 3, really shoddy work too. So those are really the ways you get screwed. So if you get multiple bids, that helps a lot. And then really what you want to do is make sure every single payout is tied to a certain milestone. So once they hit that milestone, they get a payout. You should never have it the other way where you're paying them before the milestone. That's where you get in trouble. So I'll say that covers 80 to 90% of problems. Problems always arise, right? You're working with contractors. They're pretty annoying people. So I would say even the contractors I like working with, I don't like working with a lot of the time. And that's just kind of the nature of the business. Is it better to come to the boot camp after doing other courses first to take it to a higher level? I don't know what other courses you're referring to, but I would say no. I don't think you need anything else before. It's really intended to bring you up to speed during those first 4 weeks, so you can really work on everything else in the last 4 weeks and really try and get a deal under contract. What if the first deal we source has a high vacancy rate with the bank just not loan us the funds? Yeah, they won't. You're going to need to go to other sources. So when you have a low DSCR, basically what's going to happen is they're going to say, hey, look, you either need to lower the leverage, or you need a different type of debt. So you might have to take on bridge debt in that scenario, or you might need more equity. So it depends on the deal. But yeah, in general, a bank is going to require 1.25x. Do you need a lot of volume in order to sustain a business model like this? The way I run it, no. The way most people run it, yes. And that was kind of the point I was making before, is that if you run it lean, you don't have to do deals. And I run it lean. If you have a full operation, yeah, you need to keep buying deals to sustain it. And I think that's a position a lot of people are in right now, where they're deploying equity into deals they don't want just to sustain their firm. But I'm not in that position. The bootcamp 7,500, Nader. Which asset class do you see the most opportunity in? That's a good question. I mean, I think probably the one people are going to make the biggest killing in is probably office. Personally, I'm probably not going to touch it because I think it's still very risky, but I think that's probably where people make the biggest killing. I'm seeing a ton in the multifamily space right now, like I said, and I think there are actually a lot of opportunities in the RV park space as well. So personally, that's where I'm focused. I don't see much opportunity in the industrial space right now, which is the other space I'd really want to be in. I think self-storage is a bit, once again, it's all relative, right? You could still find great deals in all these asset classes, but I think self-storage has been a little bit more overcooked just because it got institutionalized as an asset class. Would like to say this is great and appreciate you staying on to answer all the questions. Oh, thanks. What is your vetting process for legal counsel? I don't think legal counsel is that important for these smaller deals, honestly. I think once you start working on complicated deals, it is. But half the time, I'll just use like the standard realtor's contract and just try and get it closed as soon as possible. So what I'll say is usually when I'm getting legal counsel, what I'll try and do is just talk to a broker or the broker for the deal and just say, who do you guys normally use, and just find them. And yeah, maybe you have a bad experience. Maybe you need to test out 2 to 3 of them. But overall, you should be fine. Is the boot camp useful if someone is coming from the real estate agent side of things? Yeah, I think so. I mean, I think it depends whether you're a residential or commercial agent. Obviously, commercial agent is way more applicable to buying cash flowing real estate. But overall, yeah, I've had people come over from the residential side and do great too. So yeah, I think it's applicable. Roughly what percentage of students are able to find a deal in the last 4 weeks of the boot camp? I don't keep official stats or anything like that. But what I will say is real estate, there are a lot of people who get deals under contract during that period. No, obviously it's almost impossible to close, right? Because it's real estate. It's going to be you get under contract, then you're probably looking at 60 to 90 days to close. So it takes time. And I will say a lot of people find deals in the months after it as well, but I don't have any official stats at certain milestones or anything like that. That's not something I track. If you look before, I think we had 8 people or 9 people who had deals that were extremely actionable, and we had like 25 people under there at once. So I guess those are the rough stats. Which locations are you underwriting deals right now? I'm underwriting all over the country right now. Where am I? One in Missouri, one in Atlanta, one in South Carolina. Well, kind of all over the country. Sorry, what is the price of the boot camp again? It's $7,500, $7,500. 2.5 million rental properties, 140K yearly rental income at 55% LTV. Should I go full-time investing 23-year-old? It's so dependent on your plans, right? I think you really need to understand where you want to be and then chart out a path to get there. It's very hard to give a one kind of word answer for that. Any guidance on ground up land development entity structure setup? With regards to what? Is there something you're trying to optimize for there? If you're not close to the deal being done, how often are you going on site? So it depends, right? If you're looking at a deal that's actually actively in the value add process, maybe you're going on site a fair amount. If you're looking at a deal that's stabilized, I'm almost never going there. So it just depends what point the deal's at. If there's anything that's active that needs to be done, yeah, we'll go there and make sure it's getting done. But aside from that, no, I'm not going stable. If it's a stabilized deal, I won't be there for 6 months. If you're not close to the deal that's being done, how often are you going on site before actually acquiring the property? So what I will say is I would never buy a property sight unseen ever. So I would say if you're ever going to buy a property, you have to go visit in person at least once. I think after you buy, you can visit it way less often, like I said, especially if there's not anything that needs to be done from a value add perspective. But no, I would never, ever buy a deal sight unseen. I think it's a horrible idea. You need to visit first. Is the boot camp fee deductible? I think it probably is. I would have to look at it. Have you ever considered investing internationally? And if so, what markets? No. I think other markets have way worse property rights than the US. I think there are plenty of deals to find in the US, and I don't want to deal with currency exchange rate risk either. What was the catalyst for you to quit your job and go off on your own? Was the number of units under management, amount of cash flow per month, et cetera? Not really. What I will say is you almost don't want to model it, because if you model it, you'll never do it. So I know that's kind of like a roundabout answer, but I didn't have a specific metric. I just wanted to leave. I had good deals in front of me and I left. So I wasn't doing anything crazy. I wasn't kind of looking at it from like a cash flow perspective. I don't think I ran a single model. I don't think I put anything in Excel. I just kind of left. I keep in mind I have an insane risk tolerance, so I wouldn't recommend this for everyone. But I also just trust myself to always figure it out. And so I think it's a bit of a different scenario because I did have kind of other things going on as well, where I kind of had cash flow from this account and just other things that helped. But I didn't do a single model beforehand. And if I did, I probably wouldn't have left. What do you think is the better investment, RV parks or RV storage, and why? I'd have to look at it. I think it's very dependent on the deal. Overall, I would say I think RV parks are incredibly interesting right now. I think they're really overlooked. I think if you look at a few of the niche asset classes within RV parks, they're very, very interesting. Some of them are a little bit operationally intensive, but I think it's probably the last asset class that hasn't been institutionalized yet. And there are a lot of those you can buy on market for 10 plus caps, which I think probably won't exist 10 years from now. What should people be looking for in their site walk? So I think this is kind of hard to say just in a specific answer, but I think you want to group into a few categories, right? One is do you like the real estate itself? And the other is kind of like what needs to be done to the property. So I kind of group it into those structures. Figure out if you like the real estate, then figure out kind of like what the dollar amount that needs to be done to the property, whether those are actual dollars that need to be spent immediately, whether they're cosmetic dollars, and kind of group them into different buckets. And that's kind of how I look at a site walk. Thoughts on STR Airbnb type investing? I think it's interesting sometimes. I know a lot of people use it for that STR loophole from a tax perspective. I think overall you're going to be working probably, in my experience, probably 5 to 10x more on a hospitality asset than you will on a multifamily asset. I own a hotel right now. I think the deal is going to end up very well. It still probably takes up 5 times more of my time than I'd like it to. And it's just so difficult from an operational perspective because you go from an asset class like multifamily where everything comes to you, right? It's very easy to lease up. It's very easy to operate, to an asset class where you really need to push revenue, right? So that's an asset class where operations matter. So I would say multifamily is an asset class. Operations, people argue they matter. I don't think they do. I think once you go into hospitality, operations are the most important thing by far. So it's definitely a different ballgame. If you think you're a really good operator, it's a good space to be. If you think you're good at identifying assets that are undervalued, then there are probably other ways to express and make money than the short-term rental asset class. How are you getting brokers to bring you off-market deals? Did you ask them to do that? Yeah, that I do. I mean, basically what I do is I tell them my criteria, say, here's what I'm looking for. I show them that I can close. I say, here are the deals we just worked on the market, and see what they send me. And look, you'll get a lot of garbage, but you get good deals too. So it's not anything insane, I think, with that. Like I said, it's really about conveying legitimacy more than anything else. You don't want to be in a position where you're kind of just like, they think you're a joker, right? And I think a lot of people convey that when they talk to these brokers. Why would you ever buy a stabilized deal if it's already stabilized and your intentions are to define distressed value add plays? I mean, if your intentions are to find distressed or value add plays, you wouldn't buy a stabilized deal. Yeah, no, you wouldn't in that scenario. Should your first property be under an LLC or personal? I would just put it under an LLC. I think that's what your lawyer, honestly, you should just talk to a lawyer about it, and I'm almost positive that's what I'll tell you. In regards to OpCo, HoldCo, professional services company, the flow of income expenses. What was that question initially? I mean, I think you could probably do it with just a deal level entity and then the GP level entity. You could definitely get way more intense if you wanted to, but I think that's probably the simplest way of doing it. Am I buying any hotel to apartment deals? No, not right now. No. Do you have a mentor or just by learning by doing with the internet? Well, so I learned a ton on the job because my job was acquisitions in the real estate private equity level, right? So at the institutional level. So I learned a ton there. I had a mentor as well. I work with him a ton now. He's a partner on a lot of deals. So I kind of was able to experience both those. And I think he taught me more the entrepreneurial side, whereas I learned kind of the more structural side at the institutional level. So both definitely helped. And I think it always helps to have someone who kind of knows what they're doing to kind of lead the way. Thoughts on distressed asset conversion, multifamily from office? I wouldn't touch those. I think they're not going to work. Huge hassle to capitalize. It's just going to be insane. A huge headache, and you're going to pencil to like a 15% IRR. It's not going to be worth it. Anyone else have any other questions? Which market was the deal I just closed? I can't reveal the market. You can't reveal it to thousands of people. It'll just ruin the alpha in it. So I don't talk about the market there. That's the only thing I won't discuss. Connor said, following back up regarding the international deals. Yeah, I wouldn't do any international deals. I think I answered that one. Just not interesting for me. Plenty of deals in the US. How to determine it's better to risk finding a replacement property or just take the proceeds and the tax hit about $220K? I think you almost always want to. Every time I've made a decision purely based on tax reasons, it's been the wrong decision. So without knowing more specifics, I would say probably take the tax hit and not do a bad deal. If you can find a market that gets you a higher cap and an STR setup, is it worth pursuing? Airbnbs in tourist countries. I mean, the thing you have to think about, right, is short-term rental properties always trade for a higher cap rate because they're harder to manage and they're a headache. So like, it's not like you're like getting some arb there. It's just that it's going to be a worse time for you, and you're paying for that. So basically, that's how I'd look at it. It's not like you're getting like the market knows that you're not the only one who's figured it out. So you have to keep that in mind. Not to say it's a bad deal and people make a ton of money on those deals, but that's why the cap rate is higher. It's not like you're getting free money there. Shane, questions in the Q&A tab as well that didn't appear in this general section, but appreciate your time and how far and above you. I think I went through those too. There may be one or two more. I'll double check at the end. Oh, wow, there are way more. I didn't see those at the top. I'll go through those in a second. Why did you do IRR hurdle, not equity multiple? That was kind of honestly a mistake in this one. I just decided to go with IRR. Now I do every deal with both. So I basically have the greater of an IRR hurdle or an equity multiple hurdle. So I have both of those in all my operating agreements and subscription agreements now. But that I just didn't end up doing it there for some reason. It was a mistake on my end. You didn't exchange the profits here. Why not let it sit with an accommodator in case? I just didn't do it. LPs in the deal. Keep in mind too that in a deal like this, right, so much of it's our money, right? We have real estate professional status. We're barely paying tax. Then a lot of it's coming from retirement funds. They're barely paying tax. So by the end of it, it's like you're kind of doing a 1031 for like 4 LPs, and it really wasn't worth their time. Any books in real estate worth the read? No, I don't read any real estate books. So I'm sure there are, but I don't read them. It's not really what I do. What is your example equity multiple hurdle? Just wondering. So usually same exact kind of structure on the top end. So same exact promote, but equity multiple hurdle, you're looking at anywhere from 1.25x to 1.5 probably, depending on the deal, is really the hurdle there. So what's your typical spread between stabilized yield and market cap rate? I think I answered this one, just going through the Q&A tab now. Did you rely on cap rate analysis for multifamily? Yeah, answered that one too. What are the typical acquisition, asset management, disposition fees you charge? How do you determine the capex budget need if you're doing work on units? So acquisition fee usually 1% to 2% of the purchase price. Asset management usually 2% of the usually 2% of the equity on a yearly basis. I don't charge any disposition fees. How do you determine the capex budget? You just need to have a contractor walk it beforehand. You also have a property inspection report done. They'll give an estimate. I wouldn't trust that estimate, and I would really wait for a contractor's actually be doing the work to price it out for you. And I would get multiple bids, like I said before. What are some of the 20 plus questions from your first meeting? Talked about that earlier, really mainly related to the CapEx and the rent roll and the financials, because those were the real drivers of the deal. Everything else, it was what it was, because we knew we were buying it for $60K a key in a market that was worth $100K a key. So there's not much else that's going to move the needle there and actually say, like, change your decision in the deal. When doing the first few deals, is it worthwhile to invest as co-GP minority LP, or should the focus be buying as a GP operator? I wouldn't do a deal as a minority LP. I don't think that's worth the time. I don't think you're going to learn anything, and I think you're tying up your money with someone else, which personally I never want to do, especially in the beginning when you want to learn. So I wouldn't do that. I would always invest either as a GP or with your own capital. Were there any challenges associated with the condo association and board? No, because we bought all of it, so we had control from day one. So there were no challenges there. We could change whatever we wanted. What questions do you typically ask up front when reviewing a deal? So there are tons of them. What I would say is you basically want to think about it like holistically, right? Where are we starting? Right? And what is the current cash flow? Where are we ending? What is the final cash flow? And how are we getting there? Right? And that's how you really need to think about it. You can break it down into more complex pieces, obviously, from there. But once you get that framework, everything sort of falls into place and you say, all right, like, here's where we are, here's where we're going, here's the risk. And then you can really assess the deal. So that's basically what I'm doing, is I'm trying to get answers to those questions, like where exactly are we? Where are we going to end up? And what is the risk we're taking? And all those questions I ask will be around that. What are your thoughts on making a first deal out of state? I live in SoCal where the market seems tight. My first deal was out of state. Like I said, it's not ideal, but it just happens sometimes. If you're in California or SoCal, there's a 99.9% chance you're not going to find a deal there. And it's going to need to be out of state. Just is what it is. Do you do all leasing and property management on each deal? Depends on the deal. Typically what I have is either management company or live in super, kind of at the property level. Then I have an employee kind of who stands above them. And then if anything else happens there, it gets kicked to me. So there's a few layers in between me and the property. When did you start fundraising? Basically on my first deal, I started fundraising. So pretty much immediately. What should your first deal look like if you have little capital to invest? I mean, this is really up to you, right? Because anytime you're investing, it's a personal decision. So I wouldn't really look at it from just a pure, what does it need to look like? I would look at it from what are my goals, right? What's my risk tolerance? And what am I looking to get out of this? And then you find the deal from there. So I think it's hard to give a one size fits all answer for that, because it's very dependent on your personal goals and your situation. Are you raising LP capital on a deal by deal basis? Yes. So everything I do is deal by deal. I don't do any funds. Funds are a huge hassle from almost every perspective. And typically, unless you're raising like a $50 million fund, it's probably not worth your time just because of compliance. So I would almost always do a deal by deal. Could you go into more depth on the structure you have for your capital stack and how exactly the profit share and percentages work? Sure. So basically in this deal, for example, right, we own 35% of it to start out because of our initial equity contribution of 280K of the 800, which is just 35%, right? Then we also get, right, so the LPs own 65% of that. We get 30%. So basically there's a 20% promote over a 10% IRR and a 30% promote over a 30% IRR. This hit a 30% IRR. So we got 30% of the other 65%, right? So 0.65 times 0.3 is 0.195, so 19.5%. Plus that 0.35 to 35%, that's 54.5% that we got of the deal, of the profits. And that's pretty much how it works. You can force sell the condos if you own a majority of the condos. Didn't know that. Yeah, you can dissolve the association and make them sell to you. Obviously, the rules differ. You need to talk to a lawyer, blah, blah, blah. But yes. We're developers in Toronto and extremely motivated to get exposure to the U.S. market. We've got some liquidity and willing to invest. What's the best way to get in contact? Just shoot me a DM if you want. How do you set your deal parameters and determine your focus? You set them based on your goals, right? Like I said, the way I look at it is I want to do 1 to 3 great deals a year. So I'm able to set parameters around that because I know what kind of risk I want to take. I know what risk I'm comfortable taking. I know what returns I want. So everything kind of flows from there. I think what's difficult is if you don't know those things. And I think a lot of people don't. You'll ask them, hey, like, what do you want to do? And they said, I don't know. Then yeah, it's impossible to figure out your parameters because you don't know. So the first step is really understanding that and then moving from there. So that's how you do it, is you work backward from where you want to be and what risk you're willing to take. Could you talk about how you assess supply risk? Most multifamily investors seem to be warning of loss of incoming apartment supply in many markets. This is a really good question. I invest in markets that pretty much have no supply coming in. And the way I do that is essentially you have, right, there's a few ways to restrict supply. One is the government restricting supply, right? That's through zoning. The other is just not being enough land, right? Let's say you're on an island like Manhattan. And then the next one is it just doesn't pencil to build. So to me, the best one to have is it not penciling to build. And that's most of the markets I'm in, right? So if you look at it, it typically doesn't pencil to build unless the rents are around 1,800 to 2,000. So most of the markets I'm in, rents are below that, which means that no one's ever going to build because it's not profitable to build, right? Let's say, for example, I'm buying for $60K a key, right? I would say it's nearly impossible to build for under $180K a key, most likely $200K a key in any market in the country. So that means I'm buying for 1/3 replacement cost. No one's ever going to build in those markets until rents really increase, which means I make a lot of money before anyone builds. So that's really how I look at it. And I'm looking at markets with almost no supply. Like the supply will not increase in the markets that I look at. And that's one of the reasons why I'm there, is because at that point, you don't have to look at the rest of the equation, right? Once you have the supply side moving and the demand side moving, that's where you have these markets really move out of whack. And the markets that you see where rents drop like crazy, or vacancy skyrockets, that's all because supply is coming in, right? It's very difficult for demand to fluctuate that much. It just doesn't really happen unless there's an exodus of like a major employer. So the markets I'm in are very not exposed to that. And the funny part too is you'll talk to these people and they're like, you're not in a growth market. I'm like, okay, but I'm in a market with no supply increase, right? So I know for a fact that my supply and demand is going to be pretty steady, right, throughout the entire process, which allows me to actually buy the real estate and not worry about the other crap, right? Everything else that's happening. Whereas all these other people, right, they'll be in like a phoenix. And yeah, when things are going good, you do really well, right? Because rents will go like crazy because population's booming and everything like that. But everyone's going to build there too. So you're in this growth market. Now you have a ton of supply. Now you lose a ton of money. So in my view, and I think this is like pretty borne out in reality, pretty indisputable, anytime you're in a really high growth market, you're actually taking more risk than a low growth market. Because basically what you're doing is you're betting on, first off, you're coming at a lower cap rate, right? These markets, they're buying a 3 or 4 cap and you're betting on rent growth. If that rent growth doesn't happen, you're completely screwed. Whereas I'm coming in at a 10, right? Or a 9, whatever you want to call it, and stabilizing to an 18. and I'm taking zero risk there. And that's obviously an extreme example. But when you're in these markets where you're stabilizing way higher, you're so insulated from everything else that who cares if you're not getting a lot of market rent growth? It's just not a factor, right? I'm buying and I'm making a 3x the day I buy. What do I care if rents increase, right? So that's how I look at it. I think it's way safer doing it like that versus saying, hey, I hope rents go up. And like, yeah, maybe they will, and you make a ton of money, but maybe they won't. So the markets I'm in, supply is usually not increasing. As someone who does not live in the US, why do New York City and San Francisco real estate markets not work, in your opinion? Assuming it has to do with limited housing inventories and booming demand in the case of both. The entire thing is that it's a too liquid of a market, right? You make money in real estate because it's not liquid and there's fractures, and which leads to opportunity. If you have the stock market, for example, the stock market is the hardest market in the world to make money in because it's so liquid, right? It's very hard to find inefficiency. It's not impossible, but it's hard. So once you're in a market, the more liquid the market, and New York and San Francisco, New York is probably the most liquid market in the country, right? So it's the closest to the stock market. It's the hardest to find a good deal. You want the opposite, right? And everyone is always like, oh, you're afraid you can't sell? Like, no, you want to be in a market where it's very difficult to ascertain the value, because that's when you make money on the spreads, right? Because no one knows what the spread is, and that's how you make money. And that's how you get those actual kind of opportunities. So the reason why those markets are horrible is because they're so liquid that it's hard to find an opportunity. You want to be in a market that's not competitive, not liquid, and that you can find a lot of alpha in. John, is the acquisition bootcamp still $7,500? If I apply with a business partner, then would it be $15K? If you're doing it actually together and on the calls together, you can split the cost. What is the minimum amount of capital you'd expect someone looking to join the bootcamp starts with? I would say 50,000 or so, like I said before. Like I said, also, I always go back and forth on this because I've done it with less, but I would say typically 50,000. Do you recommend starting with Real Estate Guide University and then applying for the program? Not really. I would go right into it. I think if you really want to do that, you can, but I don't think it's necessary. If you had access to more GP equity and 1031 exchange opportunity, 20 to 27 million equity, how would your strategy change? I see how valuable this is in tertiary markets at a smaller size. If I had $27 million of equity that I needed to deploy right now, I would be in tertiary markets, lowballing everyone with all cash offers and seeing what's stuck. And I think you'd find some really good deals. Why isn't your cap rate equal to the interest rate on the debt? It's just not. I mean, your cap rate's always going to be, well, not always, but it should be above the interest rate, just because otherwise you're not going to make much money through cash flow, and you're probably be cash flow negative. So you pretty much need to be the other way around, where your cap rate's above your interest rate, just so you can make money on the deal. Also, a bank's not going to loan you money, or not going to loan you at high leverage at that rate. How quickly were you able to roll the inherited rent roll to market rents? Did you jack rents all the way up to market right away, or did you do it incrementally? Did you have any pushback from the tenants, or did they stay in the building? That's a good question. So I mentioned before, the rents were basically all month to month. So that allowed me to increase right away. What I will say is it's difficult to increase all the way up to market right away. Typically, once you increase more than like 30% or so, you might run into some like tenants' rights types issues. So that's what we did, is we increased it like 30%, and then we increased it again on the year mark, more up to market. So it was kind of like 2 rounds there versus 1 round. We had almost no pushback from tenants. I think it was like maybe 4 tenants left, so maybe 10% left. They were so below market. I mean, these people hadn't had their rents increased in 20 years on some of them. So there was barely any pushback. And the market was so tight too. Like I said, it's a really supply constrained market. They had nowhere to go. We were still the cheapest option by far, even after increasing rents 30%. What is the average percent of the all-in basis allocated to DD plus closing costs? Parentheses 6 to 8%. No, I'd say it's more like 2% or so. I assume total beginners should look at Class C. This really depends on what you're looking for, right? If you're looking for more of a core kind of like low risk asset, you're probably looking at Class B or even Class A. if you're looking for more of a value add deal, I would say you generally Class C. So it depends what you're looking for. I wouldn't say it's like a one size fits all. What are your IRR hurdles and GP promote? Like I said before, 20% IRR over a 20% promote over a 10% IRR, and then 30% promote over 30% IRR. That's kind of typical for us. Do you think it's helpful to take any courses prior to your course, Acre, etc.? No, I don't think so. I'm not familiar with any of their courses, but I don't think they're necessary. I think I do a very good job of explaining everything, and you don't really need anything else. What do you think about the Raleigh market? I would need to look at it. I haven't looked at it closely in a bit. What's happening with that 500 unit that it's 70% vacant? That's a crazy one. So basically, the seller sold it in like 2018 or so with a ton of seller financing, like really high leverage seller financing. The person who bought it from him, who took on that seller financing, ran it into the ground. This owner who gave the seller financing on it didn't realize it until it was too late, essentially. Then foreclosed on him. Now doesn't have the needed capital to bring it back up to where it needs to be. Now it probably needs like 5 to 7 mil of capex. So he's kind of stuck in a pretty difficult position, and he's not an operational guy. So that's kind of what happened there. It was kind of like he should never have given that high leverage to an idiot seller financing. How often are you seeing seller financing deals? I've seen some people talk about paying more for building in exchange for lower interest 5 to 7 year terms. I'm seeing seller financing all over the place right now. I think a lot of sellers are interested in that 500 unit deal. I just sent in a seller financing offer to. So we'll see how that goes. But I think it's very common right now. And it's not an insane thing to ask for whatsoever. So I would definitely ask for it. Do you only invest in real estate, no bonds, stocks, etc.? I only invest in real estate and operating companies. Once you have, like I walk through what you make in a deal before, it doesn't make any sense to do anything else when you can reliably 3x your money on a mediocre deal, right? You saw this deal was what, a 7.5x on our money? Like, why would I put money in the S&P? It just makes no sense. You're basically locking in a lower return guaranteed. So I don't do it. I know for a fact that I'm going to do very well on these deals that I do. And I know that even if it's a mediocre deal, I'm 2 to 3xing my money. So it's like your downside's like a 2x, even with just the fees, and your upside's like a 7x. I don't know. Tough to put your money anywhere else. Do you invest as an LP in other deals? No, for the same reason. Just doesn't make sense. Doesn't matter how good the other deal is. It's going to be worse than your deal with fees. Will you ever make a course with everything you know about real estate? I mean, I think that's pretty much what the bootcamp is. I'm not going to say it's everything I know. I'm sure there's a few things that aren't in there, but it's really very comprehensive. Do you think someone who goes through the bootcamp could get a decent deal with 2.5K like you did? I think you can, as long as you can raise money. So what I would say is you definitely want to have access to money there. If you're going to be doing with a low dollar amount, then it's possible. If you say you only have $250,000 and you don't have access to raising capital, I'd say you're not going to be able to fund anything. Would you do seller financing when selling your property? Probably not. I think there's scenarios where I would, but most likely no, just because it kills your IRR. Right? If you think about it, you get paid on the IRR hurdle. If your money's delayed for another 5 years, it's going to kill the IRR. It's all time based. So probably not. I'm going to shut this down in a few minutes or so. If you'd like to sign up for a call, I would do that now. Like I said, we're only taking 30, and that's kind of like a hard stop just because of we're doing everything personally there. And there's a huge time commitment on our end. So if you'd like to sign up, I would do that. It's obviously first come, first serve. And I'll stay on for another few minutes or so if anyone has any other questions. Can you talk more about how your boot camp can help in finding deals? Yeah, sure. I think it's a few things, right? One is finding a market that you can actually find deals in. I think that's extremely important. I think almost everyone overlooks that and they don't know how to find a market. So that's the first thing. The second thing is setting up an actual set of deal criteria, basically your buy box. I think that's the second thing, right? Figuring out exactly what you want to buy, where you want to buy it, what price you want to buy it at, all of that. So that's the second thing. And the third is really organizing the deal flow, understanding how to make it come to you versus you having to go get it, and understanding the best places to kind of go to for it. So those are kind of all the things I would say that really, really help there. Where do we sign up for a call? If you look in the chat, there should be a button. It says book a call to apply. It should be right in there. Yes, got it. It should be available for replay afterwards. It should just be sent to you in a link. I think I don't know. I think it's all automated through the service. I have to check afterward, but yeah, the replay should be available. Darren, what's the difference between the boot camp and the Real Estate Guide University? Yeah, good question. So basically, the university is basically almost like a library of content, I would say, that you can read at your leisure. And I think it gives you a really good baseline understanding of real estate. What I think it lacks is obviously the one-on-one nature of the boot camp with me, as well as kind of the application portion of it, which is really the entire thing, right? So the application portion is obviously the last 4 weeks. And you get that one-on-one interaction while you're underwriting, while you're learning underwriting, while you're learning how to find a market, all of that, and really helping you through that process. So it's a pretty different scope there. I would say it's drastically different. And it's really, I would say the boot camp is really meant for people who are looking to buy deals, right? Because that's what it's doing. It's helping you do that. Whereas the university, I think, is more just about learning a baseline of real estate. All right, I'll give it another 2 minutes or so, then I'll hop off. I wonder how many hours it would take to find a first big deal. Problems I haven't done as small deals, so it feels like a large leap. I mean, I think it depends on where you are, right? If you're not capable of doing a big deal yet, I wouldn't go for a big deal to start. I'd start out with a small deal. And I think obviously I'd have to know more to know if you could do that or not. But there are limitations on that. Like for example, if you want to do a $20 million deal to start and you don't have the balance sheet for it, no one's going to give you a loan. So there, you have to kind of think about that as you go through the process. It's not like you can just take down any deal size you want. But overall, I wouldn't think of it linearly, right? What happens is once you create relationships and you have the deal flow coming to you, I mean, you could spend zero time finding a great deal, or it could take 30 hours, right? You just don't know because it's not linear. And I think that's one of the great parts about the business, and also a bad part about the business is that it's kind of choppy like that. But when you find the great deals, it's a great deal and it's all worth it. All right, last chance to sign up for a call. I'm going to hop off in a minute or so. So do you suggest minimum unit size on multifamily? Well, technically, it's not multi unless it's 4 units. But no, I don't suggest minimum unit size. I think, like I said, I think it's when you're getting started, it's all about just getting in the game. Seriously, like that. That's really all that matters. You're not going to make $1 billion in your first deal. You're just not. Right? What's going to happen is you're going to hit a base hit, and then maybe your next deal, the deal after, is the deal you really hit it big. So that's how I think about it. It's really all about getting in the game. I wouldn't focus on any unit size or anything like that because, like I said, also it's not going to scale linearly, right? You do a 3-unit deal, your next could be 20, right? It really can be that simple as long as you're effective at deal structuring and you can source deals. All right, about to log off. If anyone has any last questions, feel free to drop it in the chat, and if you want to sign up for a call, feel free to do that as well.